Investing is an important aspect of financial planning that helps individuals, families, and businesses to grow and maintain their wealth over time. It involves the allocation of resources to different investments, such as stocks, bonds, and real estate, in order to generate returns. Investing can be a great way to increase the value of your money and build financial security. When it comes to investments, it is important to understand the risks and rewards associated with each type of investment. Different investments carry different levels of risk, and it is important to be aware of the potential losses that can occur when investing. Additionally, it is essential to understand the different types of investments, such as stocks, bonds, mutual funds, and real estate, and how they can be used to diversify a portfolio. By understanding the basics of investing, it is possible to make informed decisions and increase the chances of achieving your financial goals. A diversified portfolio can reduce the risk of losses, and a well-considered strategy can help to maximize returns. Investing can be a great way to grow your wealth and secure your financial future. Stocks. Stocks are pieces of ownership that represent a company's shares, or equity, on the financial markets. They are one of the most popular investments and play an important role in the functioning of the economy. When an individual purchases stocks, they are buying a part of the company and becoming a shareholder. In exchange for their investment, shareholders receive the potential for dividends and potential capital gains. Dividends are payments that the company makes to its shareholders out of its profits, and capital gains are the profit received when selling the stocks for more than their buying price. Additionally, the stock market serves as a gauge of the overall health of the economy. When stocks rise, it indicates that the economy is strong, and when stocks fall, it indicates that the economy is weak. Although stock markets can be volatile, they offer investors the opportunity to diversify their portfolios and make decent returns if they are willing to take risks. Furthermore, stock investments are protected by governments and exchanges have strict rules that regulators oversee. In short, stocks represent a piece of ownership in a company, offer potential returns in the form of dividends and capital gains, and are an important indicator of the economy's health. Investing in stocks requires research and is a risky endeavor, but can be a rewarding way to diversify a portfolio. Benefits and drawbacks of investing in stocks. Investing in stocks can be a great way to make money, but there are also various risks associated with it. One of the primary benefits of investing in stocks is the potential to make a high return on one's investments. Stocks are a great way to diversify a portfolio, as each stock represents an ownership stake in a company and provides an opportunity for investors to make money when the company does well. However, there are some drawbacks associated with investing in stocks. Investing in stocks is risky, as the stock market is unpredictable and the value of a stock can go up or down depending on market conditions. Furthermore, investors need to be aware of potential financial losses, as they may incur substantial losses if they don't properly manage their portfolio. Finally, it can be difficult to know which stocks to purchase, as investors need to be knowledgeable about the stock market and be able to pick out successful stocks. Overall, investing in stocks can be a great way to make money, but investors need to be aware of the potential risks associated with it. With the right knowledge and management, stock investing can be a great way to increase one's wealth. Examples of stocks that have high returns. Investing in stocks can provide an excellent return on investment depending on which ones you choose. Some stocks that have a history of providing high returns include Amazon, Apple, Google, Microsoft, and Johnson & Johnson. These stocks have all outperformed the S&P 500 index over the past years and have a track record of excellent returns. Other stocks such as Visa, MasterCard, and Amazon are also excellent choices for investors who are looking for high returns. Additionally, stocks in the biotech and healthcare industries have also been seeing higher returns in recent years, with many of them providing double-digit returns. Investing in these stocks is a great way to maximize returns on your investments and should be part of any investor's portfolio. The best performing stocks of all time have generated a total return of 1,240%, 373%, and 260,061%, respectively. Coca-Cola and Amazon are two of the best stocks of all time, as well as Apple, with strong competitive advantages that have allowed them to maintain high profits. Monster has been the best performing S&P 500 stock of the past 3 decades, with an impressive total return of 260,061% over 27 years. Bonds. Investment bonds are a type of debt security that allow investors to loan money to a government, corporation, or other organization in exchange for the promise of regular interest payments. The investor typically buys the bond at a discount, meaning they pay less than its face value, and they will be repaid at a predetermined rate of interest when the bond matures. The interest rate is determined by current market conditions, the creditworthiness of the issuing entity, and the length of time until maturity. As a fixed income asset, bonds provide regular income to the investor, and bondholders can also benefit from capital gains if the bond is sold before its maturity date. Bonds offer a low-risk investment option and are often considered a cornerstone of any diversified investment portfolio. Benefits and drawbacks of investing in bonds. Investing in bonds can be a great way to diversify one's portfolio and hedge against risk in the stock market. The most obvious benefit of bonds is their relative stability. Bonds are less affected by short-term market fluctuations, so investors can feel secure about the return on their investment. Bonds also offer a predictable stream of income, and in the case of short-term bonds, the interest rate is typically higher than that of other common investments, like CDS and savings accounts. On the downside, bonds often have weaker returns than stocks, and the potential for capital gains is limited. Additionally, bonds come with an element of risk, as their value can fluctuate with interest rates. Long-term bonds are especially vulnerable to inflation, and if inflation rises faster than expected, they may not be able to keep up with the changes in the market. Examples of bonds that have high returns. High-yield bonds, also known as junk bonds, typically offer the highest return of any type of bond. These bonds are issued by companies whose credit ratings are lower than investment grade, and they carry more risk than other types of bonds. Other bonds that may offer higher than average returns include floating rate notes, convertible bonds, and asset-backed securities. In general, the higher the risk, the higher the potential return. Investors should always do their homework and consider their risk appetite before investing in any type of bond. Treasury bonds offer an average return of 3.2%, while municipal bonds typically offer a slightly higher return of 3.9%, and corporate bonds offer the highest return of 5.0%. Additionally, the average annual return of a balanced portfolio of stocks and bonds is 6.62%, with the best year, 1982, returning 30.01%, and the worst year, 1931, returning -10.74%. Years with a loss account for 13 of the 94 years examined. Mutual funds. Mutual funds are investment vehicles that allow investors to pool their money together and purchase a diversified portfolio of stocks, bonds, and other securities. Mutual funds are professionally managed and often have access to a wide range of investments.
They can also provide access to investments that would be too expensive for individual investors to purchase on their own. Mutual funds are generally divided into different asset classes, such as stocks, bonds, and cash. They can also be divided into categories based on the type of investments they hold, such as large-cap stocks, international bonds, and real estate funds. When investing in a mutual fund, investors pay an ongoing management fee, which covers the cost of managing the fund. The performance of a mutual fund over time will depend on the underlying investments it holds and the skill of the fund manager. Benefits and drawbacks of investing in mutual funds. The main benefits of investing in mutual funds are that they provide diversification, professional management, and access to a wide range of investments. Mutual funds also offer convenience, since investors only have to make a single purchase in order to access multiple investments. Additionally, investors can benefit from economies of scale, since larger funds are able to purchase securities at lower costs. The main drawbacks of investing in mutual funds are that they are subject to market risk, and can sometimes incur high fees. Additionally, the performance of a mutual fund is largely dependent on the skill of the fund manager, and some funds may not perform as well as the market as a whole. Finally, since mutual funds are pooled investments, investors cannot customize their portfolio to meet their specific needs. The three mutual funds with the highest returns in history are the Fidelity Magellan Fund, FMAGS, the Vanguard 500 Index Fund, FINX, and the American Funds Growth Fund of America, AGTHX. The Fidelity Magellan Fund has seen an average annual return of 15.7% since its inception in 1963. The Vanguard 500 Index Fund has seen a 9.2% average return since its inception in 1976, and the American Funds Growth Fund of America has seen a 10.9% average return since its inception in 1973. Real estate. Real estate investing is the practice of purchasing and/or managing physical properties for the purpose of generating income. It is a popular form of investment due to its relative stability and potential for long-term appreciation. In most cases, investing in real estate involves buying a home, rental property, or other physical property with the intention of renting it out or reselling it at a later date. Real estate investing involves a variety of strategies, such as buying and holding a property, flipping, or investing in a real estate investment trust, REIT. The key to successful real estate investing is finding profitable properties with the potential for appreciation, and managing the properties for maximum return on investment. Additionally, investors should also be aware of taxes, zoning laws, and other regulations that can affect their investments. Benefits and drawbacks of investing in real estate. The main benefit of investing in real estate is the potential for appreciation and income. Real estate typically increases in value over time, and rental income from tenants can provide a steady source of income. Real estate investments are also typically low risk, since it is a tangible asset that can mostly be managed and maintained by the investor. On the downside, real estate requires a significant amount of capital to purchase, and can be expensive to maintain, as well as time-consuming if the investor is responsible for managing the property. Additionally, the rental market can be unpredictable, and it can be difficult to find tenants and maintain a steady source of rental income. Examples of real estate that have high returns. The top 3 real estate investments ever are residential real estate, commercial real estate, and real estate investment trusts. Residential real estate averages a return on investment, ROI, of 8.6%, while commercial real estate averages a slightly higher ROI of 9.5%, and REITs average higher again at 11.8% return. Investing can be a complex and daunting task, especially for those who are new to the process. As such, it's important to have a clear strategy in place when investing. To ensure that your investments have the best chance of success, here are a few key tips to bear in mind. Number 1. Understand your financial goals. Before making any major decisions, it's important to have a clear understanding of what your financial goals are. Are you investing for retirement, to fund a major purchase, or for a more short-term goal? Be sure to have a clear idea of what you're looking to achieve when investing. Number 2. Do your research. Before investing, it's important to understand the different types of investments available and how they work. Research the different markets and the different types of securities and commodities, and the risks and rewards associated with each. Number 3. Develop a diversified portfolio. Don't put all your eggs in one basket. Instead, build a diversified portfolio by allocating your investments across different asset classes. This helps to spread risk and ensure that your investments are not too heavily exposed to a single asset or market. Number 4. Monitor your investments. Investing is not a one-off process, it's an ongoing process. You should regularly monitor and review your investments to ensure that they are still in line with your financial goals and that your portfolio is performing as you expect. Number 5. Seek professional advice. Investing can be complicated, and it's wise to seek professional financial advice to ensure that your investments are in line with your goals and objectives. A financial advisor can provide tailored advice and help you make the best investment decisions for your situation. Thanks for watching, and if you liked this video, hit the subscribe button to let us know.